So today, what are the implications for businesses trying to raise funds? Tom, you just touched a little bit on this, that, well, the implications for certain companies are different than the implications for certain other companies. And I think, clearly in our audience today, we have CEOs and management teams from companies that have $5, $10, $15, $20 million of revenue. They're cash flowing. They need expansion capital. On the other side of the ledger, we're at a business launch competition today of very early stage companies, that $300,000 of cash and services would have a significant impact on. You might call that the angel end of the market. What are the implications for the companies in the various stages of growth today as it relates to venture?
Well, I think because the mindset of the venture industry is kind of moved to a bit of a defensive, risk-averse stance, just like all the other markets. Yep. The opportunity, the risk-reward opportunity, I think right now is more in the, let's call it, the late-stage venture in the growth phase. Mm-hmm. And the reason is simple. You're taking lower risk. You can analyze these businesses much more effectively by talking to customers. You've got more history that you can, dig through. Pricing right now is coming down pretty rapidly. So on a risk-reward basis, it just feels a little bit more comfortable to be doing the more later stage things. And I think a lot of venture firms have kind of taken that mindset, let's say over the last 9 months or so. I think that mindset will continue for a while. So the implication here is going to be it's going to be tougher for the startup part of the market because attention is being spent elsewhere, A. B, I think the angel community, their net worth has been dramatically impacted, and so they've pulled back out of the market. You can't find any bank to lend you anything. So I think what we're going to see is probably maybe up to another 6 to 12 months of a real chill in the early stage phase part of the market with a little bit more vibrancy in the mid to late stage of the venture market.
Great. Any other thoughts on that topic?
Yeah, I would say for those of us that grew up in kind of the venture capital era over the last couple of decades on the entrepreneur side of the table, who in many ways were trained to focus on the P&L and the revenue line and revenue growth, I would say the focus has significantly shifted to the cash flow statement and really understanding the ebb and flow, hopefully it's more on the flow side, of cash in your business. Is a significant discipline change in the way that I think businesses have been run and will continue to be run, certainly for the next several years. Revenue growth will always be important, but capital discipline, I think, is a theme you're hearing up here. And I think that the investors really develop a level of comfort and confidence in your business the more you understand and can anticipate the ebb and flow of cash in your business.
Just one other thing I'd like to add is on the risk side of the early stage investments, if you look at the exit environment for the venture industry, it's a major, major issue that the industry is facing. Both the lack of IPOs, the lack of M&A activity, and the hold period is extended pretty significantly, where, if you think about historically, it was 4 to probably 6 years, it's probably 6 to 8 years now. So pretty extended period. And when you look at early stage businesses and the level of M&A activity, you really have to think about exit values, call it south of $100 million, and as opposed to thinking about $250 million valuations as a norm. And given that, again, it really hits home to the capital efficiency standpoint, where if you're thinking about those numbers, and a traditional software company takes $30 to $40 million to reach that cash flow positive, the math just doesn't work for an investor to make an interesting return. So it really puts a lot of pressure to how do you bring fewer dollars into the business over the life of the business, where at an exit of, call it $50 to $100 million, management plus investors feel like they can make an interesting return for themselves.
Well, that's a great point, actually. And to follow up, I guess I realize I'm one of the few early stage investors on this panel. So we still believe that there are great opportunities on the early stage side. Much to that
Nelson,
particular point.
how are you defining early stage? Is early stage complete startup? Is there product? Is there a management team? Is there revenue? What definition?
Yeah, it's a triangulation, Tom. So typically first or second institutional round, maybe not a whole lot of capital invested. Certainly nominal, if any, revenues. We do like to tend to see some semblance of a product, maybe version 0.5, something that a customer or we can take to one of our LPs or take to a customer and say, what do you think of this product? If it's pure PowerPoint, we'll invest in those situations under two circumstances. One, we either know the space extraordinarily well, or two, we know the team very, very well. So we made one of those investments last year for both of those reasons. But to the capital efficiency point, what we're trying to see on the software side is that we can get to some semblance of revenues, maybe sub-$1 million revenues with $1 to $2 million of invested capital, right? Whereas 5 or 10 years ago, it used to be 5 or 10 million for a software company to get to revenues on the hardware side at probably 5x that. So we are looking for companies to actually do a lot with very little, and that basically brings home Tom's point about singular focus on a specific set of problems. We are looking at some companies, and I saw a few plans this week where it looked like they had 4 distinct businesses when I sort of treated it all out. And, it just sort of gave me a headache after a while because I couldn't figure out exactly what the specific problem was. And yet the team was very excited because they thought they had a lot of opportunities. And what was hard to communicate was, look, you don't have time. Assuming you don't raise the $6 million Series A, which is unlikely, if you get $1 million or $2 million, how are you going to make that last 18 months to 2 years? So the next round is an up round valuation, not a down round valuation on $2 million. Well, you've got to pick one of those 6 areas.
Very good advice.
Tom, one last comment, more maybe on the positive side as opposed to the Dr. Gloom side of the ledger. The current environment has created one positive impact, which is availability of great talent. There is a lot of good people being, cut out of companies for rarely their own personal performance reasons.
Right.
And that creates opportunities for people to come to small companies where they probably wouldn't have considered it before. They'll get entrepreneurial in their own mindset, and you can get people that probably wouldn't have entertained joining you with great experience. So the flip side to this whole storm that we're in is that there is a lot of good talent. There is a lot of entrepreneuring going on. If we look back to the 01-02 timeframe, which was the last disaster in the tech space, there were some great startups created because of just people have to find jobs. They have to do something. It forces them to get creative. And as a result, a lot of great companies were created. So, we don't want to forget that. And there will be opportunity. And I think the VCs will be coming back and looking for startups. It's just we have to kind of work through a lot of problems with our portfolio. And that tends to kind of, a lot of this is about bandwidth and cycles. And if you're kind of working your portfolio issues, you're not looking at new deals. Because your cycles are being spent elsewhere. That process is almost behind the industry as well. So I think, we're going to start seeing the thawing here in the second half, and I think by 2010 we'll be back on track.
I hope you're right, Tom. I know we all do. All right, let me switch gears a little bit from the kind of macro environment and what's happening on the funding side, both, venture capital companies raising capital and venture capital companies putting capital to work, to a different aspect of the venture industry, which is a very simple question. What do venture capitalists want in a CEO and a management team, if I can expand it to that? And what should a CEO and a management team want and expect and desire in a venture capital partner? Does anybody want to start with that one? All right. Thank you, Matt.
I would say that the 2 things we look for, or I would say I look for primarily, in a CEO. The first is the ability to adapt and be nimble. I think a lot of the companies, a surprising amount when you actually go back and think through specific examples, end up with a very different business plan and oftentimes a very different revenue model and even maybe product than what they started off doing. I mean, I think if you look at some of the successes even in the Valley like Google or PayPal, they spent a lot of time adapting their model from what they had initially anticipated. And I think that's a quality that you can find in a CEO and management team. The second, and actually, I think Nelson had alluded to this as well, is the ability to focus. And it seems somewhat, of a paradox, but I don't think that it necessarily is. I think particularly in times like this, the ability to look at a series of opportunities, prioritize, and then execute well in often sometimes a serial fashion rather than a parallel fashion is important. To that point, and actually to the second part of your question, I think the responsibility of a venture capital firm is to be a good sounding board for those decisions. I think you should be looking for somebody that will be proactive and will help you through difficult business decisions, that you can go and say, this is what I'm thinking of doing, this is how I'm thinking of adapting or adjusting, and they can leverage their experience working with a wide variety of companies in the past to help you steer through those decisions.
Yeah, those are great points, and the only thing I would add is that I think that the CEO is the only one that has the ability to connect what I call the outside to the inside, and that is really understanding what's going on in the market and how do you bring that in. And I always like a CEO who is very customer focused, really in tune with the customer, understands what that's about. And I think it's we often get when you're growing a company and your head's down, you tend to get a little inward, and I think you'd have to always continue to ask yourself, hey, what do I do to be outward? So.
From the perspective of a CEO and what they want in investors, I think, let me go the other way first. I think Tom said one of the benefits was great talent sort of coming out of this crunch. I think the other benefit is what I mentioned earlier, which is you wind up with executives, managers, leaders who are more disciplined financially, probably from a capital efficiency standpoint, and so it's painful but valuable training, I think. The other side, I think from the CEO's perspective, that you can't underestimate but you don't anticipate necessarily is the, I'll call it philosophical or principle alignment with your board, your investors, your venture capitalists. And I think it's akin to kind of waking up one day and finding out you're not principally aligned with your spouse and you're dealing with a family issue or a financial issue, and the pain that can create is similar when you're not philosophically or principally aligned with your investors and you're dealing with difficult circumstances like a layoff, and how you treat those employees in a layoff. If you differ philosophically in that situation, it can be really, really painful and damaging to your company and your relationship with your investors.
Point.
A couple of thoughts on CEO attributes. Coachability. A board likes to see a CEO who listens, who doesn't have all the answers. Transparency. A board doesn't want to get surprised, and a good CEO doesn't surprise his board or her board. And finally, this isn't something you necessarily have to have in the CEO, but you have to have it in the team as a whole, which is relevant experience. Because there's a lot of potholes in building a business, and if your team hasn't had experience, they're going to hit all the potholes. And when you hit potholes, it costs you time. And in this area, time equals money. And that ruins the capital efficiency component we kind of talked about this morning. So you want to build a team that as a whole has been down the path before, been down the road before, and knows what the potholes are going to be and knows how to get around them before they hit them. Because that saves you a lot of time and a lot of money.
One thing I've run around out in San Francisco quite frequently, and I actually agree with your opening comments. Thank God I'm in Atlanta now.
Right.
So we get calls from all the headhunters in the Valley who work and hire for the VC firms out there. And I think there's been a dramatic change, just like there has been in the funding. There's been a dramatic change when I talk to them and refer them candidates and what they're looking for in the CEO. It's financial acumen and effectiveness. It's someone who's got more than just nascent experience in running a business, I think. And I would classify it as somebody who's got business operational experience that can connect with the entrepreneurial ideas that are out there as well. So, and I agree with, I think, what Tom said. The talent pool out there is pretty good right now, very, very strong right now, I think, for folks to come in and run businesses.
Good. Thank you, Kevin. Because we started a little late, and we're going to try to keep the program on track, what I want to do is turn to the audience and ask you to queue up a couple of questions if you have something that's burning. Otherwise, we'll go back and finish the last couple of questions that we have prepared. Is there anyone in the audience that would like to ask a profound or otherwise important question to this panel of august venture capitalists this morning? Any takers for that positioning? All right, we have one. Tino, I thought I might. Maybe. All right, perfect. We have a microphone, or you just stand up. We have good ears. Okay, so the question, I'll just repeat it since I have the bully pulpit up here, is you've talked about giving advice to your venture portfolio companies as a venture partner and board member. What advice would you highlight for us today that you gave to one of your companies that worked really well, or quite frankly really bad, because the rearview mirror gives us a different view of the world? So I can start with one really interesting. I won't name the board member, but Glenn McGonigal and Tim McCormick are sitting right out there, and they know this story well. I had a board member that absolutely, patently refused to align with Chris Klaus and I to build intrusion detection. He said it was way too close to the firewall market, and they would crush us. And I think, as most of you know, but ISS went on to basically invent the commercial intrusion detection business, and that was really at the heart of our fame and really was a pioneering technology for the industry, because once high-speed deep packet inspection capability was available, we could apply a broad spectrum of intelligence to that deep packet inspection to detect and prevent threats. So mostly my board gave me good advice, though. That was just one we couldn't seem to get over. So luckily, Chris and I were the majority owners of the company then. We were a 3-person board. And we thanked him for his advice and told him advertising would be better suited for him. So any ideas, Nelson?
Well, I'd say that another piece of advice is to listen to your board and as counselors and thought partners, not only when it comes to customers, but also when it comes to talent and yourself, in terms of when augmenting your team and maybe yourself is appropriate. We had a recent situation where we knew going into the investment, and the team understood that the current CEO would probably be replaced, and usually we approach that with somewhat hesitancy, right? Sometimes that sort of means yes, with my sort of fingernails stuck in the door jamb. But we embarked. The company was doing extraordinarily well. We realized we needed a more senior leader to begin speaking with Fortune 500, Fortune 100 clients. We identified a phenomenal person, to be on the board. Then we elevated her to the chair of the board, and then we actually just said, how about be CEO? And this is a company for one of my partners. And so I asked my partner, I said, how is so-and-so going to take that? And apparently it was fine. And we just sold the company two and a half weeks ago in less than 7 months. So,
wow.
And she was phenomenal because she knew the CEO of the acquiring company and actually put the company in a very different plane within about a 4-month period that she was involved. So that type of leadership, and, the team's going to do great. They're going to make out extraordinarily well. So, listen to your thought partners and your board members with regards to talent and, when it might be time to bring in different leadership.
That's a really good point, Nelson. Roger?
Yeah, just adding to that, I guess talent is ultimately what makes these businesses and the management teams. So it may sound strange, but a lot of CEOs don't want to bring in superstar talent, and whether they feel threatened or what. But I would definitely surround yourself by great talent. I would also say on the flip side, there's many iterations of a management team over a life of a company, and if you make the wrong hire, for example, let's take a VP of sales, it can easily cost a company 1.5 years or 2 years to get that right. And the only advice I would say is if you think you have issues on the management team, when there's smoke, there's usually fire. And speed is important, yet you want to manage that with being very thoughtful on the decisions you make because they have significant implications. But at the end of the day, it's the people that make these businesses, and so it's definitely a top priority.
Thank you, Roger.
The thing I always tell the CEOs is that they're the biggest impediment to growth. So it sounds harsh, but I think the reality is that oftentimes they're reluctant to build out an operating team. I think it's really important to basically get that operating team in place and to delegate the responsibilities to run those pieces of the business. And the second one for me would be focus. Know your market, know who you're going after, and be extremely convicted about what you're doing. Don't get confused. And then I would say the third thing is probably understand your sales process, if you even have a sales process. Because that's the economic blood of your organization, and I think those things seem to be pretty successful for our companies.
All right, thank you. Unfortunately, we are running out of time, so I'll ask you and joining me to give our panel a great round of applause. These gentlemen will be with us for the day, so please feel free to reach out to them. Thank you for your participation.